Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans. The recent moves lower since mid-August had been mainly captured within a couple of bear channels. However, the influence of the, well, let's be frank here, the optimized February to October head and shoulders neckline, currently at 1247, initially had a tempering effect on the move lower, but most recently a disrupting effect on the move lower, even though the neckline itself is bearish. If there is a single incident, I'm going to say there's a couple of incidents that have seemingly disrupted the whole move lower and now turned the market back around and started what seems to be a juddering move higher. Well, I can think you can lay one incident definitely at the door of the large combined key reversal up and bullish engulfing pattern made on Tuesday 4 weeks ago. Prices penetrated what was then the overhead 50% Fibonacci line for 2019 to May 2021 move at 1229, and later on the 50% Fibonacci line for the April 2020 to May 2021 move at 1243, plus both of the upper bear channels. However, the next resistance, a dynamic one, proved to be a little more obstinate. Prices halted and trailed under the slowly declining medium moving average, currently at 1287, for just over a week before once again dipping down just below the 50% Fibonacci line at 1229 last week. All this action has constructed a major new pattern, one that I had warned about last week, but not quite the way prices showed last week. You see, it was a monthly key reversal, but it was a monthly key reversal down, not up, as was indicated last week. Initially, all this action had put on notice the retirement last week of targets X2, X3 and X4 below, despite it being a monthly key reversal down. Thus, I have retired all of them, giving a cleaner, less obstructive view of what is going on. And what is going on now right now seems to be this. The overhead slowly declining medium moving average capped the market, with now the long moving average, currently at 1366, entering the frame from above. This I had also discussed last week. Meanwhile, there seems to be a ragged area of support below the 50% Fibonacci line at 1229 that stretched down to the 1180 area. That was until I noticed a possible new pattern in construction here. If we look at the action from October to date, then we may have, maybe, a possible, just possible, lopsided diamond pattern. Now, prices are currently held in between the upper downtrend trend line, currently at 1291, and the lower uptrend trend line, currently at 1217. These trend lines are not fixed, nor in my mind, neither is the whole pattern, but for now it looks like a reasonable, if obtuse, explanation of the market's actions. Chicago soybean meal. I wrote some 19 weeks ago now, and I've repeated it ever since. And I quote, "The month of May was a monthly key reversal down. It's important to remember that." End of quote. Now, what I wanted to emphasize back then and every time since was that everything since May had been in the shadow of that singularly bearish pattern. However, this relationship started to break down 4 weeks ago when the market moved up over the short medium moving average, currently at 336.70, and especially up over the medium moving average, currently 342.80. This week, the link finally seemed broken when prices punched up and closed over the upper time, currently 351.30 of the key bearish 2021 Andrews pitchfork. However, this move up over the upper time could not have come at a worse time, as just above we had the significant overhead resistance patch made up from the slowly declining long moving average, that's currently at 370.80, and the 50% Fibonacci line of the August 2020 to January 2021 move at 376.70. This patch halted attempts higher 3 weeks ago and caused the drop all the way back below the broken upper time and down to the combination of the very slowly falling medium moving average, currently 342.80, the flat lower trendline extension of the broken late June to Mid-September descending triangle, currently 343.5. And then nearby, very slowly rising short medium moving average, currently 336.70, plus the interesting 61.8% absolute Fibonacci line at 336.30. Indeed, you can say the market is currently bracketed in between the long moving average and the 50% Fibonacci line that's overhead, and the medium and short medium moving averages plus the descending triangle base and the 61.8% absolute Fibonacci line that's below. It could just be that the market is now setting up the conditions for a newer, more shallowly bearish Andrews or Schiff pitch hawk for the May to November action this year. We'll see. Chicago soybean oil. For months now, I've highlighted the rather lopsided diamond pattern seen back in May to July. Looking again today, I think the days of its influence are now departing as other, initially smaller, but now more important competing patterns have started to come to dominate. We now have the not so secure overhead medium moving average, currently at 60.03, acting as resistance. I'm not wholly comfortable with this one, but it's still there and more effective in recent weeks. We also have the congestion zone between 57.64 to 59.44, which you can see as a striped band across the middle of the daily chart, with the rising long moving average currently at 59.37 within there as well. Meanwhile below, with the soft-ish support of the 50% Fibonacci line for the whole of 2020 so far at 55.43. Now, since about the start of November, the market has gone through more or less a sideways action, caught in the congestion between 57.64 to 59.44. It had a hiccup midweek 2 weeks ago, but it was not until the key reversal down made on Monday last week that we saw any effort to extricate prices from the congestion zone. Yet this move down last week also seems to have been a fake, as prices were slowed actually by the 50% Fibonacci line at 55.43 and finally stopped, surprisingly, by the February 2013 high at 53.96. Prices have since pulled back up to just under the congestion, 57.64 to 59.44, and this leaves us with a conundrum. You see, this move down to 54 even area gives us the opportunity to make a triple bottom since June. Admittedly, it's an odd looking one, but it can still be seen as such. At the same time, we have a market that seems now reluctant to move up over the congestion between 57.64 to 59.44, thus countering such an opportunity. The question is, which will become the more dominant force? Until that makes itself a little clearer, then I will retire target X2 and potential target X, target X2 in the 66.80 area for a descending wedge pattern. That's between July to September. I'd previously said on a number of occasions that this was a big ask. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.